Bill Kanatas and Ben Salzberg. Welcome to the REI Diamond Show. How are you guys doing today?
Great, Dan. How are you doing today?
Doing well.
Excellent, excellent. Wishing you well from Chicago. We have good weather finally.
Yeah, we're all in town here in Chicago for the listeners. That's not always the case. I'm in Florida all winter long, ducking this winter, but good to be
Uh,
back.
well,
Excellent. Good
thank
to
you.
have you
Thank you
back.
for having us on their show.
Yeah, for sure. So why don't we get started just so that the guests have a chance to kind of, see who Bill and Ben is. So Ben or Bill, we'll start with you. Would you mind sharing a few highlights of your real estate development career?
Sure. Started about 30 years ago, doing retail strip centers and office buildings, office condos. Did some residential that I have developed over the years, primarily bringing the land, bringing in the water, sewer, and streets, and developing the lots and selling them to builders. But after that, quickly got involved in some larger projects like ground up development of storage facilities as well as car washes and also some strip centers. We did one in Florida, in St. Petersburg, Florida, years ago, and over 100,000 square feet. Developed some Fifth Third Bank, AutoZone, stuff like that in our portfolio.
Nice. Just to understand the focus so that later when I ask questions, are you solely focused on storage as of lately?
Yeah, we're concentrating on self storage, climate controlled self storage, as well as boat and RV storage.
Yep, kind of in the same lane there. Great. Ben.
Yes. Hi. How are you? No. So I may also, but my background is um, uh, definitely focused. I'm a managing broker for over 30 years in Illinois. But my background is in engineering, MBA specializing in Six Sigma and quality. Yeah, I've been in the commercial world. I did a lot of the air rides for the Boeing Center downtown. And I saved millions of dollars, about 50 some odd $1 million, looking at companies and assessing them and making them more efficient and profitable. I looked at all of the classes of corporations that I've been working at and realized that self storage, how good it is as far as an investment and how resistant it is in the industry for any type of situation that's going on with the economy, and really was looking at it to focus on that. And so I kept that in my memory and met with Bill and I talked about it, and we're like, oh my God, we should start a company, focusing on this storage arena. And based on my knowledge and statistics and Six Sigma and Lean and engineering, brings a host of skills to be able to develop, analyze, and know where to put these particular facilities. So I we have such a great team, and I would love to discuss with you and obviously more about what we've been doing.
Yeah, for sure. So are you guys doing 100% ground up, or is there some, redevelopment of sites or even buying of going concern self-storage facilities and doing a turnaround? Like what is the primary focus of self-storage developers?
So we would love to do conversions, right? Especially in Chicago. Conversions get to the market a lot quicker because we can work through winter conditions. So our first self-storage facility, actually, we purchased a former Burlington coat factory that had closed. And it was an eyesore for the village because they stayed vacant for, I think, Ben, probably about 3 years, if I recall correctly.
Yeah.
So we came in there and we were able to talk to the city about bringing it back online and on the tax roll. We converted that one. It was about 78,000 square feet of Burlington Coat Factory. And we had the ceiling heights were high enough in one of the areas where we could actually build a mezzanine in there. So we added a second floor. And I think we have about 90,000 of net rentable. There was like
Nice.
89,980. So the total footprint became 128,000 square feet. So yes, we do love the conversion. We haven't purchased any assets that were, in trouble or needed a little bit reviving. So we either would do a ground up construction or repositioning of a closed dark space.
And then Dan, the nice thing about when you do ground up construction, you can go to the areas that the numbers fit so well, and the profitability of it is so high that it just makes sense to do ground up construction, and something that people don't understand or realize, because there's these pockets and people who are moving and growing these communities will need self storage, and those are the areas and pockets that Bill and I are filling.
And you guys are typically building these to sell, more of a merchant builder situation, build it, develop it, sell it to maybe an institutional owner at, very favorable cap rate and pay off all of the investor capital and kind of keep it moving. There's not much, if any, operating over a decade in the plan. Is that accurate?
Yeah, it is
Ideally?
accurate. Yeah. As developers, we're always willing to change our plan, but yeah, basically we're merchant builders. You hit it spot on. So we're looking to find that diamond in the rough. And by the way, I love the diamond right behind you. So Ben and I will, and the team will find that diamond in the rough and we'll polish it. We'll take it through the entitlement process. And that's really what creates the value, right? It's not easy to just find a piece of property and say, we're going to build self-storage here. There's a lot of work that goes behind the scenes. The municipalities don't love that. When we were developing car washes, they were concerned about the noise, right? The noise, we can't have that. But when you sit down with a municipality and you explain to them the advantages and the need to the community, then they open up. So it takes a while, but we do develop these self-storage. We get the communities to say yes. And we're able to, like Ben said, to his point, find the market and the pocket. Now, with that said, there are investors who want to keep this longer term. So if our partners want to stay in this for 10 years versus 3 to 5 years, then Ben and I are also open to that. So I'd like to say that the investors help guide that time frame, but more so than others, it's going to be flipping this out in 3 to 5 years because everybody wants to redeploy that capital into something else.
Yeah, and I think like for the listeners, merchant builder is kind of like fixing and flipping houses. We have a lot of fix and flip investors. We do hundreds of those ourselves per year, on the audience and on our email lists. So merchant building is like fixing and flipping a house, and then owning it long term is like the landlord who's 75, has owned everything for 40 years, never sells anything, refuses to sell, more longer term kind of operations. The merchant build, there's pros and cons to both sides. I think one of the risks that does exist in self storage is the potential for it to be overbuilt. So if they open, two, three facilities in too close of a driving radius, suddenly maybe you don't get the rent growth long term that you hoped for. I have not seen a ton of that, and I know we're going to get into avoiding that as well. So you are also doing the construction and bringing vertical. It's not just an entitlement of the land and then sell it to someone else. It's
Yeah, we
title,
do. Correct. We do
build.
dirt to doors.
Okay.
We do absolutely dirt to doors. So we will develop the whole entire project.
And then at the end of that project, let's say it's what, maybe 12 to 18 months of actual construction.
Yeah, that's about right. Once you start going construction, breaking ground, the general contractors will tell you 10 to 12 months. Again, depending on where you're building. If you're in Arizona, it's different than building in Chicago, right? So 12 to 18 months is a great window, but we've been very fortunate to get them right around 12 months.
And then you guys are also going to, the partnership on that deal is going to hold that until you lease up a percentage of the units and stabilize it, get the cash flow looking right and sell it. What time period would that be? So construction is done, and then how many more years until the build is ready to be, the fix and flip is done, we're ready to kind of like exit at the retail value, if you will.
Sure. We tell the investors 3 to 5 year window after we open up the doors.
Have you guys had some exits in the last 2 to 3 years?
Not on self-storage. We had some exits on the car washes, but we opened up our first one in 2022. We started the project in 21. That's still operating. We're over 75% occupied there. Public storage is operating it and doing a great job. Our second investment, we did exit. We exited out quickly. It was an extra space project. Ben and I purchased the land, closed on it, took it through the whole full entitlement process, got it approved. But we're talking about full plan. So architectural done, structural is done, engineering was done, permits ready in hand. We were about to go vertical, but somebody knocked on our door and they happened to be an extra space builder themselves and offered us a good dollar amount. So Ben and I decided to exit that investment and concentrate on our next two that we're working on.
Cool. So on the extra space one, was that already like a syndicated deal with partners involved at that point, or was the capital raise not quite done yet? Like, fill me in on how that shook out if there were partners and how they
Sure.
made it.
Yeah, we didn't finish the equity raise on that one because we wanted to wait until we had the full entitlement process ready to go. That's what we typically do. We try to remove the risk for the investors. So we find a property, we tie it up, we spend all of our money on, like I said, the architect, engineer, civil, all that stuff. Once you're ready to go vertical, then we start putting our private placement memorandum together and we go and we raise capital, either with individual, family offices, funds, you name it. In this particular instant, we closed on the land, tied it up primarily with our capital. And before we had the chance to go to the market and start raising the capital, somebody was interested in purchasing it. So we decided to flip it out.
So online and doing my research, I found the Hanover Park meeting minutes, and it looked almost like a rubber stamp of approval. You guys were looking for a floor area variance. It looked like they had it before. It was probably pretty simple. It didn't look like you had a whole lot of pushback in that entitlement piece that I found. Is that your experience in general? I hear a lot of nightmares. I've been involved in some where it doesn't go quick and you don't get what you're looking for. And that's the entitlement risk that you're alluding to. Do you guys have, I don't know, just the experience of 20,
I,
30 years? How are
I
you
mean, you
navigating
have to make relationships, Dan. It's building those relationships and getting everybody on the same page. So when you start to do all the work, everybody knows what you're doing.
So a lot of that is time invested before the meeting and
Correct.
paperwork is filed.
Absolutely. You know what's important to understand, and Ben can talk a little bit more about this. Ben is an elected official at a college. So when you're dealing with board members, for the first time, they're looking at you as a developer and you're here to take something from them, right? Because a lot of times developers make promises, pretty pictures. Here's our architect. We're going to drive everything to you. And then by the time it's all said and done, doesn't look as pretty as they said it was. It wasn't built to the quality as they said it was. So you got to build that trust with the community as well as the village and the board members because ultimately they're going to vote for it. But it's important to
Right.
deliver what you said you're going to deliver. Because once you don't deliver what you said you're going to deliver, it won't be long before other board members, other communities start talking about that. So I've been developing for 30 years. And when I did retail strip centers and office buildings and office condos, there was a lot of pushback. And especially, I mentioned a little bit earlier, when it comes to the car washes, people were very concerned about the noise. They were also concerned about people hanging out, washing their cars, playing loud music. And, who's going to be coming there? What's the crowd you're attracting? Same thing with self storage. Who are you attracting? Is this going to be a homeless community? Are people going to be living in your units? What's it going to look like? What's security like? And these are everything that we like to address when we sit down with the community and you sit down with the mayor and also the economic developer because these are really good concerns. I would be concerned. You would be concerned if this was coming into your community. So the key here is to really address them and really deliver. Because I think once you deliver and they understand that you're, not about taking, and you're also giving back to the community. And that's really
This is
important.
all about community development. This is all about giving back to the community. So self-storage is about giving back to every homeowner. And they have a product they can use. So it's not like, you want to get everybody on board with it.
Yeah, absolutely. Ben's right.
Yeah, I think I saw some commentary in that same application or the meetings there where you guys were talking about I don't know if it was specifically the word facade, but using certain types of doors in the design where it was going to fit more. So it almost looked like you're illustrating the Class A nature, let's say, of this product. Maybe you could elaborate more on your thoughts. So, like, we're under contract right now. We're closing a car wash that we're selling, old, existing, the kind you put the quarters in and it has the pump and the spray. And like if someone came and wanted to build that, across the street from my condo building, like I'm going to show up for the meeting and turn it down.
Right.
My buddy Glenn Steiger built like 12 or 13 of these Woody's Wash Shack in the St. Petersburg area.
Yeah. Yeah.
And they're like what I would consider Class A car washes, brand new. I mean, there are the vacuums out there, but it's like, they've got just all the bells and whistles, and it's a totally different kind of environment because, that's what I would think of as a Class A car wash. Could you touch on what you think of as a Class A storage facility, maybe in comparison to like a B or a C or something else where maybe the zoning board wants to shut that down because they don't want that there, but they're willing to put your Class A product there?
Well, I think your back of me represents it pretty good. Is if this is a generated a model, is a Class A facility. It's a very modern type of facility with the glass windows here, right? You have bays underneath that can store boats or cars. And these are the type of A class facilities, maybe 120,000 square feet, fully air conditioning, automation in there, high end facilities. So high end different types of materials being used. So those are the like type of Class A facilities.
And then what would be a Class B facility, right? Like what's kind of
For me, and to Ben's point, like one of the Hanover Park that you were mentioning earlier, they had a full drive-through. You drive in one end, come out the other end. Obviously, in Chicago, that's great for us. Also for security too. If you're going there later at night, you want to be able to stay in your car. Door closes behind you, nobody's there. You open up your car, you unload, and that gives you the added Class A security. On a Class B, for me, it may not be have all the bells and whistles. In our Class A facilities, we actually have somebody that works there. So our hours may be 6 a.m., but by 9 o'clock, we have an actual person working there. They can walk you around. They can show you the facility. They can get you registered. They can take your credit card payments, all that stuff. Some of the Class B facilities may not have that as an extra service to have somebody there. It may not be climate control. If it is climate control, it may be outdoor unloading where we have either a drive-through or drive-in bay. So I think the Class A's, and obviously they're built, brand new, right? So they have all these automated things in place, including the doors where you can lock or unlock it with your keypad. You have access on your cell phone. All those amenities go into a Class A facility.
yeah,
Yeah,
so
and then
so
you
to,
have the yep. Sorry, Dan. Go ahead.
to clarify, like the class B might look more like a row of garages or like five separate rows of
That's what
garage.
I was about to say. Yeah, one level you see it. You're driving down on some farmland. You're like, oh, look at those. Out there. One level of facilities, and you have like 20, 30 like bays. Non-climate controlled.
When I started to invest in self-storage and become partners in several organizations now, I remember telling a family member about, hey, I'm putting my money in storage. And he's like, oh my God, like, uh, is the land well located? And his mind went back to like the self-storage was more of this land bank strategy. Maybe that's how it was 15, 20 years ago, right? You just took this
Yeah.
old building and you were going to hold it until the whole neighborhood changed. And then someday it would become condos and it would be like a vibe city, Chicago downtown neighborhood with 28, $3,500 rents, whatever it is, right?
Right.
And I was
Right.
like, no, I think the entire industry has kind of shifted, right? We had public storage, we have extra space, there's a few others that are very large like that. And I feel like it's gone from land bank, the farmers trying to generate income out of those garages, to something more of a business model that operates almost like a retail concept these days, right? Like the automation, the caliber of the facade and the building behind you there, Ben. It's
Yeah.
just morphed into something a lot more evolved, I think, than it was 20 years ago, like my family member thought when I said self-storage.
Absolutely, I agree with that. It's a different mindset. People are looking at self storage now. It's more of a it's like living, right? You have an apartment or a condo. It's something that you have to have. It's not just something, second mind. It's like first, right there. Like an apartment, I need self-storage.
Yeah, absolutely. Absolutely. I probably need some myself. Both of my condo things in the basement are filled and we're like constantly just, I don't know
Yeah.
why I don't break down and become a customer.
Well, maybe by the time the show is over, we can have you on as one of our customers.
Yeah, yeah, that's right, right? So give us an idea of, I don't know, two or three of the cities where you've been successful so far.
So Hanover Park, you just mentioned, Chicago Ridge, which is a suburb of Chicago. We have a project there that will be closing on the land later on this month. And we started that project over a year ago. We had to go through the entitlement process. And to your point, a little challenging, but they welcomed the development. It's a piece of property that's an eyesore for the city. So I think the fact that somebody's willing to come in there and develop it, they're very happy about. And we got, as we mentioned, that 7B, or maybe we didn't mention it, but we were talking about a tax incentive that is available here on this property. It's also in a TIF. The village realized that they needed to create a TIF to attract developers. So we're one of the developers that they attracted there, and we're going to build it there. So we've been successful getting that rezoned. And not only did we have to get it rezoned, which we did successfully, we then needed to get also a special permit also for it because not only was the process of getting it rezoned, but you needed a special use permit to allow it to operate as a self-storage as well. So we got that one done. And we're working right now on a piece of property in Palmdale, California. The village there so far has been open to the self-storage, and we've sent them some renderings, and we're showing them what we're doing there. So I think that's going to be a successful self-storage facility as well.
Was Hanover Park the exit to extra space?
Yes.
Mhm.
Okay.
Yeah.
Yeah, I know that like when I first looked you guys up and I was excited to have you on because I mean, I see there's a lot of development going on in Chicago, but everybody who's come across my audience here has mostly been out of other areas and avoided Cook County for the tax issues. Like there is um, a monumental problem with the property tax situation in Cook County and in certain villages of Cook County and even the city of Chicago, there's certain properties, it's just so impossible to make it work. Even from the tenant's perspective, like the tenant on a triple net lease has to eat the taxes, so they have such a higher risk of large increases as time goes on. So I was like, wow, here's some guys who are actually putting a shovel in the ground in the Chicagoland region. This is amazing. I can't wait to have them on. And then it was more amazing to hear you talk about the 7B designation for the development in Chicago Ridge to mitigate that risk because anyone of my friends who's not investing in Chicago is well aware of why, and that's the tax situation, and
Of
you've been
course.
able to kind of get that as a solution. And
Right.
I guess you guys must have penciled that out. That was part of constructing that deal in the front end. It's not like you bought the land and then hatched this plan later, right?
That was that was the whole process from the beginning to get
Yeah.
that.
Absolutely. Without that
And
incentive, it wouldn't pencil out.
and Bill and I, I wouldn't say, we're pretty good um expert in that arena to make things work. And that's, what sets us apart from a lot of the rest of the
Yeah.
developers.
And that took a while. I don't want the audience to think that that's like, oh, we're just going to check that box and apply for it and we got it. It really isn't like that. A lot of hard work went behind there. You have to prove that it needs it. They're not just giving it away for no reason. This property was undeveloped, and for 20 plus years, 30 plus years, it was an abandoned site where people are just driving by and throwing whatever they can on it. So it did have some challenges with the EPA. So Ben and I cleaned that up. We that took a long, a long
Wow.
time with the EPA to apply for the plan and get it approved, et cetera. So when we close on the land later this month, it'll be completely cleaned up, and we have our incentives in place, and we're able to start breaking ground with that. And recently, you may or may not know, Chicago passed an ordinance to try to stop Chicago from developing new self-storage facilities and only allowing the rezoning in certain areas of Chicago. I think that's going to help Chicago Ridge if no new developments are being developed in the Chicagoland area. So we think that this is going to be a home run for us.
Interesting. So, phase one environmental came back bad. Phase two environmental, which is where they did core samples, also showed stuff that needed to be done. And then I think it's phase three where they give you the remediation plan, and that's what has to be approved by the EPA. Was there a cost to clean that up? Would you mind double clicking on that? I think it would be an interesting segue here for the audience.
Yeah. So, the three boxes are surprise, surprise, surprise. So we checked off all three boxes. Yeah, it took a long time to get the EPA, and the environmental engineers did a great job putting together an action plan. A lot of testing, a lot of boring samples, a lot of testing, but the EPA signed off on the actual action plan. And the bid, it's under $100,000, but it's to be said because, truth be told, until it's completely dug out and sent to the haulers and they weigh it and they accept
Mm.
it, then they send you the bill later. So we're estimating about $70,000. It's in two tranches. Tranche one is going to one site that's going to be accepting it. And then the second part of that is going to a different site, which comes with a different dollar amount. So when it's all said and done, we can follow up on another podcast, but we're estimating about 70,000, just in hauling fees and dump fees.
Yeah, and for context for the listener, I mean, the average phase one is like 5 grand. The average phase two is between 10 and 20. And I've never bought a phase three. I mean, these are due diligence items, and you're paying for this money while you're under contract for the land. You don't even know if you're going to be able to clear the environmental and buy it. I mean, do you mind sharing insight on the cost of just the engineer's work to come up with that plan, Bill?
Yeah, so the environmental engineer is probably in the neighborhood of about 40 G's
Yeah.
when it's all said and done. The civil engineer is, in the $70,000 range. And so this is where development is very risky. And hopefully this keeps some people, not wanting to develop right next to you, if that makes any sense. Now, Chicago Ridge is not going to allow another one because there's just not a market for it. Hanover Park, too, when we talked to the village, they said they're not looking for any more self-storage directly in Hanover Park. And that kind of limits our exposure from another guy opening up across the street. So that's, good or bad. But we like to do all this work before we bring the investors in. So the investors are not taking the risk on losing the money. Ben and I are taking the risk up front, and then there's risks and rewards, right? So when we do go vertical and we do have investors come in, there's a balance between the risks and the rewards on development sites.
Have you guys ever killed a deal, during this part before you got entitlement and you just lose all the due diligence money? Like, what's the hit rate? Are you 50% of the sites, 70, 80, 100% of the sites, clear it and get to being able to build?
I mean,
Ben,
sorry, Bill, there
no,
are
go ahead.
dead costs involved in any type of development, and you build it
Absolutely.
into the business plan.
Yeah, exactly right. Ben hit it right on the nose. We walked away from a deal in Plainfield that just didn't pencil out for us. We walked away and lost money on an earnest money in Hampshire, Illinois,
Mm,
from a deal that we thought was going to go good. We had one in Michigan, didn't lose any money on that one, but had that tied up. And and money is also time, right? So when
100%.
we're driving to the sites and you're looking at them and spending time with not only mine and Ben's time, we have a team here as well as consultants. So you spend money, you spend $5,000 on a report here, 5,000 report here, and you end up walking away. But yes, it's
Mhm.
a dead cost, but that's part of the development game. You know, we're not new to this. Like I said earlier, we've been doing this for 30 years. So there is money that you're going to lose on some of those deals, and you just make it up on the ones that will be your home runs.
Yeah, and for the listeners, I mean, if you're going to invest in a ground up development, I think that helps paint the picture for where to look out for the risk. Where are they at in the process? Do we have the plans before they're asking for the wire or no? So let's double click on this site in Chicago Ridge just to walk through what this looks like from the investors. So we'll start with how big the site is, how big the building will be.
So the footprint, it's a three-story building. It's going to have a full drive-through. So you'll drive in one end, unload, and then drive out the other end. We'll also have a drive-in bay for unloading. So you get the benefit of either a drive-in or a drive-in bay or a complete drive-through. The site's about 5 acres. Footprint of the building, about 128,000 square feet. Public storage is going to be our operator on that one. And Civil is finishing up all their drawings right now so we can submit to the MWRD for the water and sewer. We won't have a full sewer line there, but we'll have it for storm water. And we're finishing up with the architecture right now. But to be honest with you, we're waiting for a little bit more tweaks on the unit mix. We learned from our development that we had in Burbank that we probably should have had more of the 5x5s, very popular with people in this area. And the 5x5s also generate more money per square foot. So it makes more logical sense to put more of the 5x5s. 10x15 seems to be popular. So we wanted to change the mix to add some more 10x15s here as well.
Interesting. Do you guys have any insight on what the, I don't know, the cost basis will be, maybe the cost to build per foot, that kind of thing, and then maybe what the finished or projected stabilized exit price per foot might be?
So we have about $81 per square foot on the cost of it. And obviously that doesn't include the land cost. You know, we think it'll be worth somewhere in the neighborhood of $20 million, $21 million.
It's about what
So
they go for. Yeah.
yeah, so 128,000 gross. I can't do it that quickly in my head, but Ben's a statistician. He could probably do it quicker than I can. But all in all, the development is going to be about $15 million. Actually, it's going to be a little bit less, probably about $14.5 million. So, capital from the investors, let's just say $4 million. And if you exit at $20 million, it's not a bad day.
Yeah, I mean, I guess I'm doing the math on 21 million, it's like 164 a foot. Does that sound about right?
It could, yeah,
Okay, all right.
yeah.
Who's a buyer for this kind of thing? I mean, Public Storage, I would have assumed they were the owners, and but no, they're actually doing like management and operating a facility. Do they gear up and then eventually buy this from you guys, or are a lot of these buildings that we drive by and see all the time owned by third party other investment institutions?
Well, we were hoping that you would be the buyer for it, so that's
I
one of the
bet you
reasons we
did.
agreed to be on the show.
That's right, exactly right.
If you ask a Public Storage why they got into the business of third-party management, it wasn't to make a profit. They and I don't know if they're making a profit today. I'm assuming they are, but that wasn't their motivation. Their motivation was to get in there, have a presence, continue to grow their brand, and while they're in there, they're looking at your operations clearly. They're driving the revenue to your property again, so they know where they're going to be in 6 months from now, 9 months from now, from 12 months. So they're the likely buyer. Same thing with Extra Space and CubeSmart and any of the other guys that are offering third-party management. So it is our goal to sell it to them, but not necessarily to them. They may not be the best buyer. Extra Space might want to increase their footprint and throw Public Storage out and become an Extra Space, or CubeSmart, or any of the smaller ones, Store Track, any of those guys that are coming to this
Space, yeah.
market, Prime, any of those guys that want to be here potentially can be a buyer here.
Yeah, and one of the things we were working on trying to get Extra Space to exit us out of quite a bit. And then the stock price changed. So their appetite to buy had changed, right? So you're
Of
having to,
course.
play the market from Public Storage or this one or that one. So what does the waterfall structure look like here? Like what percentage of the deal goes to you as the general partner? What percentage goes to the passive investors? And then maybe you could talk about things like the IRR, the cash on cash, and maybe the minimum investment and that kind of thing.
Sure, be happy to run that through. So in this particular model, what we're looking to do is we're going to bring investors in for the full capital stack. And for argument's sake, I'll just say it's $5 million. It's less than that, but just easy numbers. And Ben and I typically will take some of that equity stack ourselves to show that we also have money on the LP side. We break it up between the GP side and the LP side. The general partners take on the majority of the risk, and they will sign and guarantee the debt, where the limited partners will not guarantee that debt, right? So they'll come in after the debt's already secured, ready to go vertical. They're not going to sign on the loan documents. Ben and I will do that. And these loans are full recourse, which means if something goes south, they're coming after Ben and I and our company and assets. They're not coming after the limited investors. We set it up where they own 100% of the preferred shares, which are Class A shares, and Ben and I and our company would take the Class B shares. So they have 100% ownership of those. We give them 60% of all the profits when we liquidate the asset, and we also give them a 10% preferred rate of return on their investment. And there may be some distributions prior to exit of the investment. And in this particular one, we're shooting in year 3 that will have some revenues to start paying some of that pref rate. But if we fast forward to the end of the day and we're ready to sell the asset, the investors will get the accrued 10%. So the first check that would be written is obviously the mortgage. You pay off the mortgage. The second check will go to the investors. So they get 100% of their equity back. Then the next check will be a 10% accrued from day one, even when they give us the money, not when we open up the doors. So then they will get that money. And then what's left over will be a 60-40 split, 60% in favor of the investors and 40% in favor of our company.
Yeah, and ordinarily I would probably look for something that's a 20-80. A lot of the private equity deals that we do are like 20% to the GP, 80% to the LPs. However, those deals are structured recently, even ones I'm invested in, with maybe a 6% preferred return. So having the 10% preferred return, I think, helps maybe tip the needle. Then when the 10% pref is caught up, now you guys are doing 40-60 to the limited partners. That's accurate?
Yeah, that's accurate. And I've seen similar deals. And Ben and I have also invested in other deals, obviously, too. And sometimes you got to peel back the onion because the sponsor might have a guaranteed fee for the for signing on the loan. So there's a percentage or 2 or 3 there. They might have an acquisition fee. There might be a few points in there. There may be some other fees in there. And then at the end of the day, it may not be too far off from a 60-40 split. So
Yeah, that makes
I'm
sense.
yeah, I'm always telling
Yep,
investors, read the private placement memorandum, understand where the money is going, look at the sources and uses, make sure you understand that, just so everybody's, as we always say, apples to apples, right?
that's right. I have a few wrap-up questions here, but I want to give you a chance to plug a website or any contact information. Now I think would be a good time to do that.
Sure. Ben?
Well, yeah, we have a website, self dash storagedevelopers.com, www dot self dash storagedevelopers.com. For that. I believe people can contact me if they need to contact me. I would love to have. I always put out my information. My cell phone number is out there to everybody. 847 338 5517. 847 338 5517. Anybody can definitely give me a call. And my email is very easy, B like boy, SALZBERG at self-storagedevelopers.com. Love to talk to everyone.
I think we forgot to plug the IRR expected on that deal, and I think that might be helpful and maybe a question.
The cash on cash too, by
Yeah.
the way. Yeah,
Yeah.
exactly
Yeah.
right. The most important question.
Right. That's a great question. Um, the target IRR is north of 20%. I think right now we're about 21.22, and the cash on cash is over 30%. And luckily for us, we're getting a new model from Public Storage that's coming through again. It looks like the market rates have gone up in Chicago Ridge. I looked at it this morning. I think we're at $1.85 for the walk-in rate, and the online was 160, 170-ish. So when we get the new model, and we typically do a new model right before we're about to go vertical. So assuming the rates get a little bit better, then it'll be a little bit better on the IRR. If the construction costs come a little bit lower than we have anticipated, I know you're like, oh, is that possible? It is possible. So, and Ben always works with our engineers, so we could do some, cost savings there. Then that might also help the IRR as well.
And
Are
the,
there
and
any
the,
are there any cost seg benefits there? Are you guys going to build it to a cost segregation where there might be some tax benefits that way?
Yeah. We're planning on doing that as part of our, yes.
Yeah, and for the listeners, everyone who invests in these kind of deals, builds these kind of deals, runs syndications, we all are collectively holding our breath right now on what is it called? The big beautiful tax bill or whatever. If it passes and it has our costs 100% bonus depreciation, we'll all be dancing a jig here, and raising money will be a lot. It'll be a lot easier for the syndicators, and it'll be a little harder for the little guy to get his 50, 100, 200 grand into each deal because they'll go so quick.
Yeah.
Yeah.
especially in this economy, Dan, now, the uncertain times and what's happening with uh, with Wall Street, this is a great time. I mean, real estate is really a good time to invest in, and self storage is really king on that.
Yeah, 100%. So quick couple of questions here as we wrap. Is there a book? I'll ask each of you individually here. Is there a book that you found most helpful, let's say as you were getting into real estate development, or something that in that real estate development world, this book came along? It could have been any time over the last 20, 30 years, whatever it was, but is there a book of that nature that would be like very interesting to read coming from that context?
For me, it's less of a book and more of an author. So 2009, I went to a Jack Canfield conference. I had just finished doing a bunch of real estate, and I found Jack. I'm not sure who told me about it. I went there, and I liked the way he delivered. He wasn't talking about real estate, he just talked about the business mindset and what you should be thinking about. And he talked a little bit about meditation, a little bit about visualization. And I connected with that. And that was what, 20 plus years ago. And to this
Wow.
day, I still, listen to a little Jack Canfield, or I listen to visualization, or I take time in the morning to try to visualize Chicago Ridge and it's under construction and it's working, and it helps me through my, you know, times of continuing to push forward as a developer.
Ben?
So I'm part of the family office club, um, and with Richard Wilson, he created a book called The Family Office, and it talks about kind of managing investments for family through family offices and even for real estate. And I believe I love that book. That's a book that I believe in, and I agree with kind of the philosophies that go about in that book for investment. And that's how I think that a lot of small offices and single family offices to invest in this type of assets class. And so I really enjoyed reading those books, especially those family office books, because everybody is it's really a small business, right? Even though they grow large corporations, it starts small and it starts with the family. And so that's why I love reading these family office books and the family office club. I kind of love that type of area and talking to all these people and and associating myself with fantastic people that have the same mindsets as
Yeah,
far as
Richard
investing.
was a guest on the show a few years ago. I
Oh, there we
remember.
Oh,
go.
Yep,
You know what I'm
yep.
talking about that.
great.
That's right.
So,
Yeah, it
so
must be
yeah,
5 or 6 years
so
now.
yeah. So I really enjoy him. I really enjoyed that. The club. I just came back from New York. You met a lot of great people, and I like I said again. To me, it's like a family. It really is.
Nice. So my final question, which I'm going to ask each of you individually again, we'll start with you, Bill. What is the kindest thing anyone has ever done for you?
Oh, outside of my wife saying yes.
There you go.
Um, I had a old boss of mine. I'm talking about 30 plus years ago. And I started working as a loan officer, and I wanted to buy the mortgage company. I didn't like the way my boss was running it. So one day I jokingly said to him, "Sell me the company." And he said, "All right, smart ass, pardon me for the listeners." He goes, "Give me 100 grand." So I went to my old boss who knew me and trusted me, and he gave me $100,000, and I bought that company. And I think that launched my career. Not I think that definitely launched my
Wow.
career. And it was a handshake. He knew me, he trusted me, he gave me $100,000. And so I think that was probably one of the nicest things anybody's ever done for me.
I love it.
And
Ben?
and for me, I ran for political positions for Oakton College as trustee. I mean, they voted for me. I mean, that was the kind of thing that people can do, to write down and vote for me. I was working for a corporation. I turned them around. The CEO comes to me and says, thank you, Ben. Job well done. I love your work. We couldn't have done this without you. You saved our company. So I think that was kind of the kindest words I've ever heard.
Nice. I hope that if we asked that corporation the same question, they would say Ben Salzberg came in here, and that would be their answer. He saved our company, right?
That's
That would be
There you go.
exactly. Yeah, they would. They really would.
Can,
Yeah.
can I do a plug? Are you okay
yeah,
with that?
yeah.
Well, the one thing that Ben and I are involved with, and I didn't say it because it's just something that we do kind of as a passion project, but almost 15 years ago, I co-founded an organization called Feed Six, and listeners can go to feed6.org. And we've packed almost 9 million meals here in the Chicagoland area. I partner up with the Chicago Food Depository, Northern Illinois Food Bank, Salvation Army, and I get together with corporations. So, we just Ben and I just did an event with Fifth Third Bank and the Chicago Blackhawks at the arena downtown. We packed 50,000 meals and we donated to the Chicago Food Depository. So we're doing it all the time. So in the Chicagoland area, Dan, if you're around, love to have you come to one of our events. We do a signature event every November rather, with the Chicago Wolves, and we call it Hunger Heroes, where we pack 100,000 meals for veterans, and we distribute that to veterans. So love to get your listeners involved to come and help us pack these meals, and then we donate them. It's something that we love to do as our give back. So, we talked about earlier with the villages. You can't always just ask. You got to give. And this is part of our giving program. So we've done 9 million meals, and hopefully we'll be at 10 million next year.
Well, there's a great place to wrap the episode. A lot of our Chicagoland listeners, I'm sure this will be right in our backyard here, and we'll have to meet up in person there.
Absolutely love to have you guys out at an
Absolutely.
event.
Great. Bill,
Dan,
Ben,
thank you.
yep, thank you.
Thank you.
Thank you so much.
Thank you for listening to this episode of the REI Diamonds Show with Dan Breslin. To receive email notifications of new weekly episodes, sign up at www.reidiamonds.com.